Okay, welcome back to the Road to Retirement. My name is Chris Anselmo with my co-host Tony Shore.
Yeah,
Trying to get that radio voice like Tony has.
yeah, Tony Shore. All right. Well, it's great to be here with you, Chris. And I was just about to tell you we started the show, but I will tell you and our listeners, I had the most amazing experience last weekend. I flew to Las Vegas to meet a friend of mine who got us tickets to see U2 at the Sphere in Las Vegas. And I don't know if you've heard about this thing.
No.
It cost $2 billion, almost $2 billion to make. It is the world's largest high definition LED screen because it's a complete sphere and the entire inside is an LED screen.
Wow.
Like the entire thing. And it's like 10 stories tall, this thing. It's unbelievable. And the pictures and videos that you see online do not do it justice. It is unbelievable. You have to experience it. So if you ever have a chance to get out there, right now it's U2 playing a residency there until February. And then I think it's Fish and then the Eagles, I think might be the next band.
I thought you were going to say you saw me in Fortune magazine.
Oh,
I mean, come on, I'm in Fortune magazine, and one person's called. So
I did wear my Brookside Tax quarter zip while I was in Vegas. So
it's funny, we get in Fortune magazine, and then my wife shops all the grocery stores and all the pharmacies around town, and nobody carries Fortune anymore. It's like subscription only. I'm like, well, that was good. So I did have a friend call me when I was on vacation.
Oh, are you in Fortune recently?
Yeah, just in the October issue.
Well, congratulations. I got to get a copy of that. I did not know that.
It's regional, so it might not be up in Minnesota.
Oh,
but we could send you a copy.
Yeah.
Okay, well, awesome. Today I thought we'd talk about investing with protection because a lot of clients have been nervous about the markets, and also with an election year coming up, that's always, no matter what side of the fence you're on, it's always a little intimidating that year. So I thought I'd bring up a screen, and we've talked about some of this on other shows, but it's good going into the new year. So I'm going to try and bring up my WordPerfect screen. So don't.
Okay, let's see if you can do it.
So let's see. Windows.
Well, yeah, and investing with protection, you're right. I mean, we've covered different aspects of that on other shows, but it is, especially as you head into a new year and we wrap up 2023, it's really good to see where you're at and to make sure that you're doing it correctly. I think the answer is to work with a financial services professional like yourself, right?
Yeah, sure. Yeah. I mean, you need to talk to somebody who's knowledgeable in these areas, because this isn't stuff you see every day. Like you wouldn't just pick this up on the news or whatever. So it really depends on how much protection you want. We have products that offer 100% protection, like savings account, checking account, CDs, things you can grab at the bank easy enough. But usually those don't really give you much upside because they're very short-term instruments. And, if you're only going to, if the bank knows you can take the money out tomorrow, they can't really give you a great interest rate because they need to be able to hold on to and same thing with insurance. They need to be hold on to the money for a while so they can invest it on their end and be able to give you higher interest rates. So, and I think most of the listeners know, look, usually a 5-year CD pays more than a 1-year CD, right? So similar things here. So one that we use a lot when we're trying to either compete with banks or we want to make sure there's 100% protection. Now, also depends on the claims paying ability of the insurance company. So
yeah, that's true. Yeah.
So part of that is, you want to make sure you're using quality insurance companies, A-rated or better, probably. Okay, so there's one product called, and we talked about this on others, fixed index annuities. So these are products where you are not actually invested in the market. Okay, so you give the insurance company your money, and they do whatever they want with it. So, but they're going to pay you interest for borrowing your money. So they're going to pay you interest, but it's going to be based on one of the indexes. It might be the S&P 500, might be the NASDAQ, there's a variety of interest calculations you can run. But for our example, let's just use a simple one. Let's say it's just a yearly interest rate, And there's things on here called caps. So caps would be, they are going to tell you the most you can make in any 1 year. So let's say the caps right now are between 8 and 10%, which are really high. I mean, the caps right now have probably been the highest we've seen in 15 years.
Yeah.
So this might, even a couple of years ago, caps are 2-3%. So there was no real excitement about putting money away for 10 years and having 2-3% potential. So the caps, since interest comes up, the insurance companies have to compete with the banks, so they raise their caps too. So in our example, there may be a cap is 8 to 10%. So that means in any 1 year, let's say you start the product today, 1 year from now, if the index goes up, you would get the first 8% or 10%, whatever your cap is. So if it goes up 3, you're going to get 3. If it goes up 4, you're going to get 4. If it goes up 20, you might be capped out at 8 or 10. So those are pretty good upsides for products that don't really lose any money. So
you're saying the principal is protected,
correct,
but you can make as much as
the cap,
which it could be as much as 10%.
Yeah. Right now we've seen a little, I didn't want to put too much on here, but there's probably some even a little higher than 10 right now.
Yeah.
The trade-off is you're going to have limited access to your funds. So if you buy a 5 or 7 or 10 year product, you're basically loaning the money to the insurance company for those amount of years, and they want to limit your access, so they know they have the money for 5 or 7 or 10 years, and then they can invest it accordingly and make whatever they need to make and pay you your interest rate. So most of the products out there limit you to taking out 10% a year through the life of the product. So if you have a 5-year annuity, you could take out usually 10% a year after the first year, and then after the 5 years is over, you could take it all out. Okay, where unlike a CD, most of the CDs you can't take any money out until the term is over, and unlike CDs, you pay tax on the interest even though you're not getting it. So here, the tax is deferred, and you don't pay any tax until you take it out. Okay, so
interesting.
So basically, conceptually and probably legally, is you're just making a loan to the insurance company. So
yeah, you're not investing it in the market, right?
You're not actually investing in the market. Now these have been portrayed many ways over the years, and one reason it changed from the word equity indexed annuity when it first came out to fixed index annuities, because people were getting confused. Equity would mean you're actually in the market, like you have a stake in the game.
Sure.
So you're really not in the market here. They're using the indexes to figure out your interest rates, but all the shenanigans that go on and all those calculations are just to determine what interest rate you're getting.
Yeah.
So those
which is good. That's a positive.
So we use a lot of those for people who just can't stomach the market, or really just look, or they have, some people have a significant amount of money and they look, I don't need to take the market risk. If I could get 5 to 10% on my money, that's good enough, right?
Right.
And I could sleep easy.
Yeah.
Now there's some other products that came out in the last few years. They're called structured alternative investments, where they're actually through super large banks. And the Goldman Sachs of the world and things like that.
Is that what I hear referred to as a structured note?
Right. So they can be structured bonds or structured notes. So what happens here, it's similar to the index annuities, but you're actually in the market, but they can structure these where they can offer you some type of protection. There's even some that give you 100% protection, and they're usually shorter term, either a year to 2 years long, maybe even 18 months. And the caps might be like 8%. So we saw one recently. It said it was 100% protection, and a cap over a 24-month period was like, I think it was, what did I see yesterday? I think it was like 16% or something like that. So you can make up to 16% over the 2-year period. But again, it's day 1, day whatever, 365 times 2, right? So while your money's going up and down in the market, as long as you stay in the product, they're going to guarantee you 100% protection.
But you'd be locked in, like for that example, you'd be locked in for the 2 years, right?
Correct.
You can't touch
Correct.
that money for 2
Right.
years.
So it should generally, most of them don't let you take the money out.
Right.
But we use these sometimes with people like, I don't want to tie it up for 5 years or 7 years or 10 years. So
Sure,
you got something that get now those come in all types of flavors. There's some with less than 100% protection. And then what happens there is those caps will increase. So your caps might be, 15, 20% if you're willing to take on some of the risk. Right. So we see a lot of those out there. And then there's products that have come out in recently through insurance companies that offer partial protection. So partial protection would be, let's say you have a 10 or 20% protection level. So that means you start when you started the program, you put $100,000 in, and let's say you have a 20% protection level. And next year, this time they say, well, if that 100,000 drops to in the 20% one, if it drops to $80,000, we're going to reimburse you and give you your 100. Okay.
Not bad.
So, but if it drops to 25, you're going to be out 5%. You're like, okay. But on the flip side, they give you higher upside. And some of them offer what's called trigger rate. So trigger rate versus a cap. A cap, let's say they're a cap of 10%. So that means if that index goes up, you get the first 10%. But to get 10%, it has to go up 10%. Right. So these trigger rates might be 10 to 15%, which means as long as the 100 grand doesn't go down. So in our example, you put in 100. If it's still 100 next year, we're going to give you the trigger rate. The trigger may be 10%. As long as it didn't go down, you're getting 10%. It doesn't have to go up 10%. It's triggered. So as soon as you meet that criteria, it flips the switch and you get that rate. So we've used this in the past, and the ones we've been using are 1-year products. So we've been using one that has a 15% protection level, and the cap currently was 10 or 11. It was not a cap. The trigger rate was 10 or 11%. So I looked at an example a year ago. Someone had his account made 0.74% for the year. But he got 14.5 because the trigger back then was 14.5. So as long as the account did not go down, you got 14. You get the trigger rate. So as long as it stays the same or goes up, you get the trigger rate. Now, if it goes up 30%, you're only getting the trigger rate, right? So you're capped out. But where we use these is, it's a 1-year product, and if I can get.
And is that through an insurance company as well? Okay.
Sure.
Okay.
So, I looked at it this way. If you could tell me you could give me a 15% protection level on the market any 1 year, like the market generally, we had some stats here somewhere, loses 15%, maybe 1 out of every 15 years.
Yeah.
It's not often that we lose 15%. And there's some that are 20% protection too. And then you could say, well, so for almost most of the time, I got that protection. But if it stays the same or go up, I'm going to get this rate. I'm okay with that on 1-year product.
Yeah.
So that might be a way to be invested in the market, but have some protection. And it's only a 1-year product. So after the year, what happens after the year, they give you a new rate. So like the one a year or so ago was 14.5. Yeah. So the new rate might be 11. So you have you could, after the year's over, you could take it out, or you could say, okay, I'll just I like that rate. That's good enough. I'll stay in it. So it's really nice that you give, people want, with everything going on in the world, people want some protection on their money, because no matter how good your money manager is, no matter how good we are, we're investing in the market, we cannot guarantee that the money won't go down. Right. So insurance companies are allowed by law to offer this protection. I mean, that's all insurance companies do, right? They offer auto protection, they offer house protection, boat protection, life protection. I mean, that's all.
And you're just using these products to insure your money, basically, and make sure that it doesn't go down. And I think Chris, it gets really more critical the older you get. So as we get older and closer to retirement, or especially if we're in retirement, these are the types of vehicles we're looking for. We want to invest with these levels of protection, because nobody wants to say in 2021, hey, I'm retiring next year in 2022. But all their money through their 401k and their IRA is all just out there in the stock market. And then they go to retire and they need to take their yearly salary out of those accounts. And the market went down 20% in 2022.
Right.
So you need to protect against that, because that would derail your retirement plan. You might have to go back to work, or you'll be run out of money a lot sooner if those things happen.
Absolutely. So we use these to offer some protection, some peace of mind. People are a little timid right now about getting into the market. We don't have the greatest political environment right now. It's no matter what side of the aisle you're on. So that's a concern, like who's going to get in, what's going to happen. So especially in an election year, I would want some protection. And these products weren't around, like this partial protection wasn't around. It's only been out for, as long as I know, maybe 3 or 4 years. I'm okay if you could give me 20% protection on the way down, and you could tell me I can make 10% on the way up. 10% is good enough for 1 year.
Yeah.
Right? And they're like, well, what? And it doesn't have to go up 10%; it just has to not go down. So if the market only went up 1%, you're getting 10.
Yeah.
Right. So you made like
a good way to beat it. It's a good way to beat inflation too.
Yeah, you made 10 times what the market did that year. So some of this is just, you got to be careful. You got, people have to deal with someone who knows these things, because, again,
every product isn't right for every person.
Yeah.
Right.
And the market, no matter how great the money managers are, and Gradient has great money managers, they can't guarantee downside protection. Right. So part of these, Gradient has, went to banks like the Structured Alternative Investment, says that this is what we want. Can you build a product to make this happen? So that's how we got some of these structured alternative investments, so that people are looking for protection. And they even came up with a couple now. The last one is kind of you wouldn't believe this, but it's called dual directional. So it means that you can make interest if the market goes up or down. They're like, what? So usually the caps might be smaller. Let's say there's a 7% cap. So that means you put your $100,000 in next year. If the market goes up 7% or less, you get whatever goes up. If it goes up 10, you're only getting 7, right? So you're capped out at an upside.
Yeah, if the market has a big boom and goes up 20%, 25%, you're getting 7.
Okay.
If the market drops 20%, you're protected for the first 7, but after that,
right. So
lose.
and those, I just picked a rate. There's some that are 10. There's some that are
a little bit more. This is just an example.
Yeah, right. So on the way down, so let's say the market went down 5%, but you had a cap of 7. So they're actually going to pay you 7.
Yeah.
Even though the market
went down 5%, you're going to earn 7%.
Right. So there's these ones are a little more difficult to explain, and we have to kind of map them out on the whiteboard for people. So for instance, some of them, let's say there's a cap of 7 and it went down, and so the first 7% you're getting 7, right? So it went down 9. What happens is you're getting 7 minus 2, so you're actually getting 5, right? So it's really not until it goes down 14% that you're not getting anything, right? So some of these strategies are out there, but you don't just hear these on the the local evening news or the Susie Orman show or things like that. Sorry, Susie. She's great, but everyone knows who Susie is, right? So so talk to your investment professional, ask him for something that's got some protection. Like, hopefully you'll do with us. Oh, by the way, 440-886-3550. Is that a pretty good Tony Shore voice?
Yeah, that was
so
good.
BrookesideTax.com. So these are ways of having some protection but still be participating in the market, because traditionally when you have 100% protection, you don't get much upside, right? So you buy, you stick your money in a savings account, they're giving you 0.5% because they know you can take it out tomorrow, right? So part of it is you're going to have to give up some liquidity. But a lot of these dual directional ones are maybe 1 year or 18 months. So you're really not having to lock it up for a long period of time. And the other thing that we've used these for probably the last 4 or 5 years is bond alternatives, because with interest rates going up, bonds were going down. So this was a way to, normally when the traditional way is like, I want a 60-40 portfolio. I'm going 60% in stocks, 40% in bonds. And that's how I'm going to get my diversity. And that's how I'm going to limit my, have some protection a little bit, or limit my risk. But the bond market's been crazy because of how interest rates have been flying around. Yep. So a lot of times we might still keep the 60% in stocks, give you a little more upside, but we'll use one of these products for the 40%. So,
yeah.
Hopefully you guys can see all that, and don't tease me that I'm still using WordPerfect, but
I was about to. Yeah, I cannot believe I haven't seen WordPerfect in a while.
Yeah. I used WordPerfect when it was DOS.
I did too. I've been using WordPerfect a long time, or I did a long time ago. Yeah. I stopped using it though a long time ago, Chris. But okay. Hey, it works.
Yeah.
Chris, that's really good because people, their risk tolerance, they have less and less tolerance for risk as we get older. We all do. I mean, it's just the way. If you've got money saved up for retirement, which hopefully you do through a 401k or an IRA, some type of retirement account, you want to make sure that you have a plan to turn that into income, and that money you're not pulling out of the stock market. All of that money isn't in the stock market and at risk. So when you pull it out, your account goes down, you lose the compounding interest. You're pulling money out when the market's down, so you're losing money that way. You've got to have some protection in there. And I'm glad you went over all the different possibilities. I don't think people know that there's so many options out there, and it can get complicated. Everybody's situation is different. And so, Chris, you're there to help people, right?
We are. So, our firm, for those of you listening, our firm's, everyone says our firm's unique, but, our firm, we're CPAs, and we also have attorneys, and we have investment advisors, and we have insurance professionals. So you really can run the gamut. You pick and choose what you need. But, we kind of pride ourselves that our left hand knows what our right hand's doing. So, if you just go to an investment advisor who doesn't do insurance or taxes or estate planning, they don't see the whole picture. And so
right.
A lot of our clients like the fact that we built this one-stop shop. So check us out at brooksidetax.com. I'm not you can see I'm not the guru with the ticklers here, but brooksidetax.com or 440-886-3550. And I don't know. Will we have another show maybe before Christmas? I'm not sure. So
yeah, maybe one more.
If not, everybody, happy holidays. Tony Alley, will see you in January. Are you going to Nashville?
Oh yes, we're going to be in Nashville at a big conference.
Nash Vegas, baby.
Nash Vegas. We'll be there for a big conference in January, a big financial conference with some of the top minds getting together to really go over how you can help your clients better. And I think it's good to do that. Yeah. I know you like to do those things, and it'll be fun to see you there. We'll hopefully record a show while we're there.
Yeah, we can do that.
Live from Nashville.
Nash Vegas.
How about that?
So I ever tell you, I'm a CPA, my wife's a CPA, so we're, pretty conservative, right? So we're in Monaco. Woohoo, Monaco. And we go to this casino, and it's $10 cover charge just to get in, right? So I'm playing this game. I'm up $11. My wife hits the button. Cash out. We're out. Oh. So I took down Monaco for $1. So
yeah, there you go. There you go.
Yeah, I'm not a Vegas guy.
I'm not a gambler at all.
I think last time I went to Vegas, I don't even think I put a quarter in the slot machine.
Well, I was just in Vegas last weekend to see that show, and I didn't gamble once. And the time before that,
that's how they can build those billion-dollar buildings there.
Yeah, but the time before that, when we were there for the financial conference a year ago, I didn't gamble once. No one believes me. Like, you didn't put a quarter in a slot. I'm like, nope.
Same thing. Did you go to the Bahamas?
No, I didn't go to the.
So, but we stayed at a resort that was actually a casino. So same thing. I didn't play.
Yeah, I just gambling's I love to play blackjack, but I don't like just throwing away money
on your phone.
Yeah, exactly.
All right, exactly. Tony, take us out.
All right. Well, that does it for today's episode of The Road to Retirement with our host, Chris Anselmo.
All right.
Thanks, Chris.